History and development of accounting. It first started way back in 4000 BC. On 4000 BC, the income of the temple was recorded in Lower Mesopotamia. On 2500 BC, historical accounting records had been found in ancient civilizations of Egypt and China. During that time, accounting records were kept by rulers for taxing and spending on public works. On 1000 BC, the Phoenicians created an alphabet with accounting so that they were not cheated through trades with ancient Egyptians. On 500 BC, Egyptians carried on with accounting records and even invented the first bead and wire abacus. On 423 BC, the auditing profession was born to double-check storehouses as to what came in and out the door. The reports that were taken by these accountants were given orally, hence the name auditor. In year 10, Emperor Wangman, 45 BC to 23 of Qin Dynasty, of China instituted the first known income tax of a flat rate of 10% profits. In year 12,000 to 1493, in 13,000, accountants were mentioned in historical records for the first time in Statute of Westminster, indicating they are considered important. The first requirement for businesses to keep accounting records spread across many of the Italian republics in the 13th century. These records were mainly taken to keep track of the day-to-day transactions and credit accounts with other businesses. In 1327, early books from the Commune of Genoa displayed an early form of bookkeeping. The oldest double-entry books entitled Massari, Treasury Officials' Ledgers of Commune of Genoa, were written in 1340 in today's accounting system. This is simplified into the T account and expanded into the ledger. In Florence, writing debits over credits accounted for its double-entry recording. In today's accounting system, this is similar to preparing journal entries. In 14,000, the Italian trading period saw sophisticated accounting systems developed within banking houses. Double-entry bookkeeping was discovered. During this period, there were two prevailing approaches to reporting. These were the Florentine approach, journal entries, which was introduced by Amatino Manussi, and the Venetian approach, ledger postings, which was introduced by Andrea Bargarico. In year 1494, Luca Pacioli, the father of modern accounting, wrote his famous paper, Somma di Aritmetica, Geometria Proportions e Proporzionalito. The treatise that he wrote was mainly studied that Pacioli performed on the common practices of merchants in Venice, Florence, and Milan. He revealed that several merchants kept books of debits, which meant he owes, as well as credits, which meant he trusts. With this early double-entry accounting system, merchants were able to maintain records so that they could improve the efficiency of their businesses. With these records come to the primitive income and balance sheet statements. In year 1500 to 1700, as the time progressed, large and small innovations were added to the double-entry records. For example, the East India Company developed invested capital and dividend distribution during the 17th century. This also created the need for a change in financial accounting and managerial accounting. The first for presentation to gain investors, and the next was used so that the business could be run as efficiently as possible. Jacques Savary, in his Commercial Code of France, 1673, used historical cost of the basis of valuation. In year 1700 to 1900, during the Industrial Revolution, accounting really took off as industrial companies sought out to gain financing and maintain efficiency through operations. Several of the double-entry accounting methods was truly developed in this area, as there was a focus on businesses as never before. Shortly after the first accounting organization was developed in New York in the year 1887. Napoleon Bonaparte, in his Commercial Code 1804 and its Supplement Code of Commerce of France 1807, asserted that assets must be carried at their market value and not based on historical value. Eugene Schmallenbach utilized price level accounting as the basis of valuation. In year 1913, the first income tax law in the Philippines was enacted. In year 1920 to 1940, accounting in the 1920s became important to reduce the amount of fraud and scandals that were performed in businesses, particularly in the United States of America. In 1923, the first Accountancy Law Republic Act No. 3105 in the Philippines was passed. This law created the Board of Accountancy, BOA. In 1940 to 1970, globalization of businesses resulted in diverse accounting practice around the world, thus the need for harmonization. In 1967, the accountancy law in the Philippines was revised and passed under Act No. 5166. This law standardized the accounting education and regulated the practice of accountancy. This law also spelled out the examination process of CPA registration. In year 1973, the International Accounting Standard Committee, IASC, was created through an agreement made by professional accountancy bodies from Australia, Canada, France, Germany, Japan, Mexico, the Netherlands, the United Kingdom, and Ireland, and the USA. Headquartered in London, United Kingdom, the committee is an independent private sector body with objective of achieving uniformity in the accounting principles which are used by business and other organizations for financial reporting around the world. The pronouncement designated as International Accounting Standards, ISAS. In year 1975, in the Philippines, the accounting law was revised and passed under Presidential Decree No. 692. In year 1984 to 1996. In 1981, the Philippine Institute of Certified Public Accountant, PICPA, created Accounting Standards Council, ASC, to establish and improve accounting standards accepted in the Philippines. Until 1996, most if not all of Philippine accounting standards called Statement of Financial Accounting Standards, SFAS, were based on accounting standards in the USA. In year 1997, the Philippines started transitioning from applying American accounting standards to applying IAS. In year 2001, the International Accounting Standards Board, IASB, succeeded in the IASC. It has still adopted the body of standards issued by the IASC, but moving forward, all standards were designated as International Financial Reporting Standards, IFRS. In year 2002, the European Union, EU, required all EU-listed companies to adopt IFRS starting 2005. In year 2004, in the Philippines, the Professional Regulation Commission, PRC, created the Financial Reporting Standard Council, FRSC. This replaced the ASC and was created to assist the Board of Accounting, BOA, to carry out its powers and functions provided under Republic Act No. 9298, the Philippine Accountancy Act of 2004, complementing IAS and IFRS were the Philippine Accounting Standards, PAS, and the Philippine Finance Standards, PFRS. Republic Act No. 9298, an act regulating the practice of accountancy, repealing for the purpose of Presidential Decree No. 692, otherwise known the Revised Accountancy Law, was also passed and enacted in this year. In year 2005, the Philippines became fully compliant with PRS.